every day it feels like we're bombarded with headlines. Trade wars escalating, companies bringing production home, nationalism on the rise. It paints a pretty vivid picture, doesn't it? One where the tightly woven fabric of our global economy is starting to unravel, signaling the dawn of deglobalization. It sounds like a massive reversal, a fundamental shift in how the world works. But what if that popular narrative, the one we hear so often, is actually missing a huge piece of the puzzle? Today, we're taking a deep dive into an article that boldly challenges this very idea. It's titled Deglobalization is a Myth, Inge, and it comes from Robert Gross, Jonas Gamso, and Roy C. Nelson from the prestigious Thunderbird School of Global Management.
Yeah, and what's truly fascinating here is that while the public conversation often fixates on a decline in global integration, these researchers present compelling data-driven evidence. They suggest that economic globalization is not only alive and well, but actually thriving. Our mission today is really to dig into their data, understand their reasoning, and discover why this perspective is so incredibly important for, well, for every one of us trying to make sense of our interconnected world.
Okay, so we're going to start by exploring why this idea of deglobalization has taken such a firm hold in people's minds. Then we'll dive headfirst into the hard evidence that paints a different picture, maybe dismantling some of those common assumptions. And finally, we'll unpack what this all means for you, for businesses, and for international relations in the 21st century. So let's pull back the curtain and see what's really going on. The deep dive. Deglobalization is a myth. So let's kick things off by understanding the magnetic pull of the deglobalization narrative. What are the key forces, the currents of thought, that have made so many of us believe that global integration is in retreat?
It's a powerful story, no doubt. And the article highlights several compelling drivers. Firstly, you've got strong populist forces at play, emerging from both the political left and right. These movements often coalesce around anti-globalization sentiments, tapping into anxieties about economic changes.
Right.
Think of the widespread political shifts we've seen in recent years, often fueled by leaders campaigning on a platform of putting our country first, as researchers like Roderick pointed out back in 2018. This is basically economic nationalism, where rhetoric resonates deeply with public anxieties and promises to bring back some imagined past. And then there's the public perception aspect. Voters in many countries often link globalization directly to perceived negative impacts. They see foreign competition as a threat, manufacturing jobs moving overseas as a personal loss, maybe immigration as a drain on resources.
Yeah.
They believe these factors contribute to low and unequal wages, creating this sense of uncertainty and unpredictability that threatens their livelihoods. This connection between globalization and personal economic insecurity is a recurring theme, observed by sociologists like Giddens back in 2000 and political scientists like Hogg in 2007.
That fear is definitely palpable, but is it purely an emotional, sort of instinctual pullback, or are there legitimate economic pains that globalization has inflicted, which then get amplified by this nationalist messaging?
That's a really crucial question, and the authors certainly acknowledge the perception of negative impacts like job displacement or wage pressure, and those anxieties are very real for many people, absolutely. But the article's core argument is that attributing all these issues solely to globalization or believing these issues are causing a systemic reversal, well, that might be oversimplifying a complex reality.
Okay.
Take the Pew's Global Attitude Survey in 2014, for instance. This was a time when populist support was brewing in the U.S. It showed fewer than 20% of Americans believe trade actually creates jobs or raises wages.
Wow, fewer than 20%.
Yeah, that stark statistic illustrates the deep skepticism and fear driving the narrative. This combination of fear and nationalistic messaging leads people to believe that populist leaders have significantly curtailed international trade or investment. But the article insists the data tells a very, very different story from this popular perception.
All right, now for the part that really flips the script. Because while the political rhetoric often feels like we're heading for global divorce, the data, according to Gross, Gamso, and Nelson, tells a story of an enduring, maybe even deepening global marriage. Let's crunch those numbers and see what they actually reveal.
Yeah, let's do that. If we connect this to the bigger picture, the aggregate data clearly challenges the deglobalization narrative across multiple economic dimensions. It shows this remarkable and often overlooked resilience. It's a powerful counterargument to the prevailing sentiment.
Okay, let's start with what most people think of when they talk about global trade: goods. Physical stuff moving across borders. The article shows that world trade in goods and world income have grown pretty consistently for decades. Now, while there was a slowdown in that growth during the 2010s compared to, say, the hypergrowth of earlier periods, trade in goods remains incredibly robust. It's hovering at or above 40% of global GDP. So it's not shrinking in absolute terms, but rather growing alongside a rising global economy.
Exactly, and this is such a critical distinction because while trade's share of a booming global economy that's gross domestic product, or GDP, while that share might fluctuate, the absolute volume of goods crisscrossing our planet is still at peak levels.
Right.
So when you hear about trade share of GDP falling, it's not because trade itself is declining. It's often because the overall global economy is growing even faster. This fundamentally contradicts the idea of deglobalization in trade.
Okay, so that makes sense. The pie is getting bigger, so even if trade's slice looks proportionally smaller for a bit, the slice itself is still huge, or even growing.
Precisely. For businesses, this isn't about retreating. It's about navigating a larger, richer market, not a shrinking one.
Many people focus exclusively on tangible goods, but what about services? This is a massive and often overlooked part of the global economy, right? Everything from software exports to consulting, tourism, financial services. How does that performing?
You're absolutely right to highlight services because they are a huge, dynamic part of the global economy, and the data is even more compelling here. Trade in services has actually grown much more rapidly than trade in goods or overall GDP in the past half-century. Much more.
Really? Faster than goods?
Yeah. With the exception of a brief anomaly in 2015-16 and, of course, the unavoidable disruption of the COVID-19 pandemic in 2020, its growth has not slowed during the last decade. This offers strong and often ignored evidence against the deglobalization narrative. The world is relying more, not less, on cross-border services, whether it's international calls, online streaming, or global business process outsourcing.
So what we're seeing across the board, from tangible goods to intangible services, is a consistent picture. The widely reported decline in trade just isn't showing up in the aggregate data. It almost begs the question, if trade isn't the problem, what is fueling this deglobalization narrative, especially when it comes to the nitty-gritty of tariffs? Because what about all those headlines about tariffs, especially during the U.S.-China trade disputes? Doesn't that mean barriers are going up, that countries are becoming more protectionist? It certainly feels that way in the news cycle.
It does feel that way. But despite the intense news focus on specific conflicts, the reality is that tariff barriers have fallen to very low levels globally over decades. For developed nations, often referred to as OECD countries, that's the Organization for Economic Cooperation and Development, the average tariffs, which is the tax on imported goods calculated as a percentage of their value, or ad valorem, have been consistently low, under 5% since the mid-1990s.
Under 5%.
Right. China, for instance, moved close to 7% by 2020 as part of its WTO requirements, the World Trade Organization rules. That's a significant drop from over 20% in the mid-90s. Even the U.S. and China, with all their disputes, had overall average tariff levels of only 1.6% and 3.4% respectively in 2019.
Wow. Okay, so the averages are still really low despite the specific high-profile ones we hear about.
Exactly. And while there are those specific exceptions, like U.S. tariffs on auto and steel imports or China restricting foreign companies in telecommunications and banking, these are not new phenomena. Historically, such restrictions, think of President Reagan's voluntary export restraints on Japanese cars in the 1980s.
Ah, yes, the voluntary ones.
All right. Those haven't led to widespread systemic protectionism. So claims that these current disputes will usher in a new era of deglobalization should probably be viewed with considerable skepticism. It's often more about targeted political maneuvering than a full-scale retreat.
Ah, the voluntary export restraint's a classic example of a diplomatic wink and a nudge. It's a good reminder that trade politics often have a longer, more nuanced history than today's headlines suggest. But if not tariffs, what about other kinds of barriers, like quotas or subsidies? These are often called non-tariff barriers, or NTBs. Essentially, anything other than a direct tax that makes trade harder. They do seem to be a growing concern.
You're absolutely right. NTBs have indeed increased in recent years. They've become primary ways states protect markets, according to the 2021 Global Trade Alert. However, this raises an important question. What's mitigating their impact?
Okay.
Well, the article points out that the proliferation of free trade agreements, or FTAs, happening concurrently with these rising NTBs can significantly counteract their effects. Researchers Kinzias, Sandkamp, and Yalsen noted this in 2019. Moreover, FTAs often serve as testing grounds for rules later adopted by the WTO, and states use them to strengthen their position within the global trading system, as Mansfield and Reinhardt discussed back in 2003.
So they reinforce the system rather than detract from it.
Exactly. It suggests they actually reinforce the global system. It's this complex dance between protectionist impulses and deeper integration efforts.
That's a fascinating paradox. More barriers, but also more agreements designed to tear them down or at least work around them. Okay, beyond goods and services, how is money itself moving across borders? That seems like a fundamental measure of globalization and interconnectedness, the very lifeblood of the global economy.
It absolutely is, and the data here shows incredibly strong growth.
Yeah.
Foreign direct investment, or FDI, which is when a company invests directly in another country, like building a factory. FDI has grown dramatically since the early 1990s. There's a clear upward trend despite some volatility after the 2008-09 financial crisis.
Okay.
And other international financial flows, like portfolio investment into bonds and stock shares and foreign exchange transactions, have also continued to grow significantly. For example, foreign exchange transactions grew from US $1.2 trillion per day in 2001
$1.2 trillion.
to an astonishing US $6.6 trillion per day in 2019.
Wow, 6.6 trillion a day.
Per day. Just think about that jump nearly six-fold in less than 2 decades. That's trillions of dollars moving across borders every single day, powering everything from international trade deals to, your next online purchase from another country. These trends demonstrate no evidence for deglobalization. Quite the opposite. They show an ever-tightening financial web. Oh, and it's also worth noting that international migration, another often cited aspect of globalization, the movement of people across borders for work, study, or family, that reached new highs in the late 2010s, showing yet another dimension of persistent global integration.
And what about that huge disruption everyone experienced, the COVID-19 pandemic? Didn't that fundamentally change things? Didn't it force companies to rethink global supply chains and seemingly trigger a drive towards reshoring and self-sufficiency?
Well, while COVID-19 certainly caused severe impact and highlighted significant supply chain vulnerabilities, absolutely.
Yeah.
It also paradoxically underscored companies' dependence on global supply chains.
Ah, interesting. So it showed how much we rely on them.
Precisely. Government interventions during the pandemic were mostly temporary responses to an unprecedented health crisis. They illustrate the kinds of disruptions international companies should plan for, yes, but not a fundamental long-term reversal of globalization. In many ways, it revealed just how deeply integrated the world economy actually is, forcing businesses to adapt within the global system, not abandon it.
Okay, so pulling this all together. If deglobalization is indeed a myth, at least in these core economic terms, and the global economy is far more resilient and interconnected than the headlines often suggest, what are the practical implications? What does this mean for businesses and even for you navigating this complex world?
Well, what this article really hammers home for international managers is that getting caught up in the deglobalization narrative could be a massive misstep. It could potentially cause them to completely miss out on the incredible opportunities that robust global trade and investment flows still offer. This isn't a time to retreat. It's really a time to strategically adapt and engage.
So it sounds like adaptability and smart risk management are absolutely key, rather than a full-scale retreat from global engagement.
Precisely. Companies need a much greater focus on sophisticated risk management. This involves diversifying activities.
Yeah.
Think geographic diversification of business operations and suppliers, so you're not putting all your eggs in one basket.
Right.
It also means adapting business models, like how Apple contracts out manufacturing to specialized firms globally, rather than doing everything in-house. And critically, it means transferring risk to expert insurers, like the World Bank's Multilateral Investment Guarantee Agency, known as MIGA, or large private insurers like AIG.
Okay.
They can protect against political or economic disruptions. And finally, it means strategically avoiding high-risk activities and locations where the political or economic landscape is simply too volatile.
What about the ongoing U.S.-China rivalry, though? That certainly feels like a form of decoupling, especially in high-tech sectors where each country seems to be trying to isolate the other.
You're right that companies will definitely have to account for frequent trade-related disputes and what the authors call selective decoupling. This is where companies in each country might be excluded from certain sensitive sectors in the other. However, and this is crucial, this does not mean full disengagement. Both countries have a profound vested interest in the continuance of globalization. For businesses, this means it's more important than ever to diversify partnerships. Look to other emerging markets in South and Southeast Asia for offshore assembly, for instance. and actively seek new consumer markets globally. It's about building a more resilient, distributed global footprint, not abandoning it.
And it's not just about the big global powers, right? Local contexts matter too, and businesses often face unique pressures on the ground in the countries where they operate.
Absolutely. There are increasing pressures on international companies to, carry out more activities locally, pay more local taxes, employ more local people, bring in new technology. These demands exist in most countries, reflecting local aspirations for economic development and benefit. Additionally, some sectors, like hydrocarbons, oil and gas, face increasing scrutiny and may need to diversify into different industry sectors or maybe upstream, downstream activities to manage changing global expectations and environmental regulations. It's about being globally connected, but locally responsive. And let's not forget those stark lessons from the pandemic. COVID-19 vividly illustrated the risks of very lean, just-in-time supply chains that had no buffer against disruption,
Yeah, that became painfully clear.
didn't it?
Yeah.
It highlighted the immense importance of geographic diversification of suppliers. These are crucial insights for managers. Some adjustments, like video conferencing largely replacing certain types of business travel, may even become permanent, which shows a shift in how global business operates, not necessarily if it operates globally.
Right, adapting the methods. So, as we wrap up this exploration, what's the critical message here for those in the halls of power, the policymakers wrestling with these global forces?
That's a really important question for them. Policymakers need to explicitly recognize that erecting barriers to trade and investment, other than to prevent clear violations of international rules, comes at a direct cost. It imposes higher prices on domestic consumers and lowers product availability. While such actions might be politically justified for some pressure groups, it's ultimately a net cost to the country overall. The challenge, then, is to skillfully keep economies open and benefit from globalization while simultaneously shielding workers in vulnerable industries from job loss and dislocation. Successfully balancing these complex tasks is absolutely key to overcoming anti-globalization opposition and, well, harnessing the immense benefits of an interconnected world.
So, what does this all mean for you listening right now? This deep dive into deglobalization as a myth clearly shows us that while the narratives of decline are powerful and frankly persuasive, the hard data from Robert Gross, Jonas Gamso, and Roy C. Nelson tells a fundamentally different story. Globalization in its economic forms is remarkably resilient and continues to shape our world in profound and undeniable ways.
Indeed. It underscores that while challenges and disruptions like populism and pandemics are very real and certainly require adaptable strategies and careful navigation, the underlying currents of global integration remain incredibly strong. Understanding this can help us move beyond the often emotional rhetoric to make more informed decisions and engage in more strategic thinking, both personally and professionally.
Which leads us to our final thought for you. If deglobalization is indeed largely a myth, as this research suggests, how does that shift your lens when you look at economic headlines or even consider your own career path and opportunities in a world that remains so undeniably and deeply interconnected?